And we covered the process in session 2. One of the bits of homework there was, if you're not familiar with it, to go and do the systemized investing challenge section, which is a canned process to take you through doing trades and filling your portfolio. So all the tangible, touchy-feely stuff, that you touch the keyboard and do stuff and point and click is in session 2. But now we really want to start, because the main game, once you have a process, is to really get our mind in tune with the environment in which we're going to execute. So let's get into talking a bit more about that. Now, chapter 6 was the homework. This is about thinking from the market's perspective. And Mark Douglas starts off talking about the uncertainty principle. And that states and you can read what the uncertainty principle is, but it's effectively over a large sample, achieving a certain outcome where every single event within that environment that you take on is uncertain. So achieving a certain outcome over a large sample where you have random results and uncertain outcomes for every time that you do something, every time you take a trade. So there's going to be quite a few quotes. What we've done here is we've taken out specific quotes that are relevant to the points we want to make. So we're highlighting the points we want to make here, but obviously it fits into the context of the whole chapter. And we're just wanting to keep you on the straight and narrow and ensure that you get the really big points the first time that you go through, if it is the first time, or even the second, third, fourth, fifth time you're going through trading in the zone. But just to hone on the really important points that are coming out of our combined experience and positioning that with other training and other skills gaining steps that we're going to take you through. So we're going to take you through just reading some stuff out of trading in the zone here. So if there's such a thing as a secret to the nature of trading, this is it. At the very core of one's ability to trade without fear or overconfidence. So he's handling the euphoric side when we're really getting into the portfolios shooting through the roof. Perceive what the market is offering from its perspective. So to put ourselves on the same side of the fence as the market, rather than sit here and the market's over there and it's an us versus them thing, is that we actually want to be empathetic with the market. So we want to perceive what the market is offering. Stay completely focused in the now moment opportunity flow. And we've talked about what is the opportunity flow? Well, it's your edge. Your edge defines the opportunity for you in the time frame and the approach that you're taking in the market. Because really there are so many different ways that you can define what the opportunity flow is for you. And we have one that's we've discussed before. It's a medium term, swing trading, trend following mechanical system that defines our flow. And spontaneously enter the zones when you're in the flow and the market is offering from its perspective an opportunity in the now moment, is that you react spontaneously to that without any association and projection into the future through expectations, wanting to be right, fearing losing, all that sort of thing. As you spontaneously enter the zone and you act, you actually do something in that environment with the view to continue doing lots more samples, events. There's a strong, virtually unshakable belief in an uncertain outcome with an edge in your favor. So that's the uncertainty principle, is you have an uncertain outcome and you absolutely and totally and utterly believe, every bit of who you are, that for this event, this trade, you're going to have an uncertain outcome, but you have an edge over a large sample that's in your favor. And that's this clash of uncertainty versus certainty. The edge is certain, but it's over a large sample. And this is thinking in probabilities, which we've spoken about already in session 3. So continuing with that.
The best traders have evolved to the point where they believe without a shred of doubt or internal conflict that anything can happen. Fundamental truth number 1.
Correct.
They don't just suspect that anything can happen or give lip service to the idea.
So this is part of who they are. It's not just saying it, it's actually thinking, feeling, and doing as well.
Their belief in uncertainty is so powerful that it actually prevents their minds from associating the now moment, the situation and circumstances, with outcomes of their most recent trades.
And I think powerful, highlighted uncertainty, belief in uncertainty is so powerful. That means it overpowers everything else that you might believe. And this powering is degrees of, isn't it? It's so the more powerful it is, the higher the degrees of it being etched into your subconscious, is that when you are challenged with something that you used to do, a bad habit, a bad way of thinking, is that the energy you have in this uncertainty principle overpowers all these other bad habits, bad thoughts that you've had with respect to trading the market, and it de-energizes them. So the energy of the power overcomes and de-energizes these bad habits. And so it prevents your minds from associating what's happening now with the past or trying to project it into the future. That's how we're in the zone in the now moment.
And so that's a really powerful result, if you like, but through thinking that and really believing that anything can happen.
Absolutely. And that's what Mark puts to us. And if you've done your homework, and we covered the 5 fundamental truths in a previous session, is the anything can happen is what, and the complete and utter powerful energized belief in that does what everything else is, but de-energizes all the other beliefs that are not conducive to what you're trying to achieve in the market. Yeah. What is the market offering? What is the market offering? Is it a bite, like the dog? Is it pain?
Yeah.
Is it an opportunity to profit?
Yeah. Certainty or probability to profit.
So is it offering certainty?
Well, there is no certainty in the market, is there? We don't know what's going to happen from A to B.
Correct. But this is the uncertainty principle, isn't it? Is that for any individual event, there's total uncertainty.
However, with an edge over a big sample size, we do start to see the realms of certainty.
Correct. And the certainty isn't definitive to 2 decimal points, but it is definitive in terms of making a profit. A casino doesn't know how much profit it's going to make because that's dependent on how many punters there are, how many spins there are, and how many card games are played, and all those variables. But it knows that it's certain that it's going to make a profit. And that is the mindset that we have to bring to the market. And now what we don't know is the same as a casino, the house doesn't know, is the time frame over which that's going to happen, because all these variables are at play in the market all the time, and every moment in the market is unique. But we can't say, the 31st of December 2025 or 2024 or 2020 or 2030, I'm going to have X%. Well, we can't do that. But what we can do is say that over a large sample, over the long term, we can make a profit because we have an edge in our favor. So that's certain in an uncertain environment. And we are just talking about probability to profit, not dead certs here. And that's like everything in life.
Perspective from which you make yourself available takes into consideration both the known and the unknown. For example, you've built a mental framework that allows you to recognize a set of variables in the market's behavior that indicates when an opportunity to buy or sell is present.
That's our edge. That's our flow.
Yeah. This is your edge and something you know.
So the point we're trying to make here is that you have to have some trust in your edge. And Mark Douglas talks about fundamental versus technical, and we've spoken about language versus price, and as your input mechanism, as your communication mechanism, and the market communicates in price. And we won't go into the discussion now, but there's something that there has to be a degree of trust in it, and there has to be a degree of track record in it, and there has to be a degree of credibility in it, and sufficient for you to be able to go and execute it. Having said that, because Mark's talking here about you becoming a trader in the long term, and that's what we're on about, but we've got the skills acquisition plan that we're starting with. And Mark's made it quite emphatic that when you do the skills acquisition plan, you really, the edge, if you like, is to put you into the flow, just has to be completely no wiggle room, has to be completely unambiguous and objective. With that is how you build the mental skills to be able to then continue executing your investment plan, which is your definitive edge, which you must have trusted. Now, can you trust in subjective rules, but that's an oxymoron, no such thing. But can you put that kind of trust and belief in subjective criteria, which are chopping and changing all the time?
It's chopping and changing, so I don't know how you could ever do that.
But you can't measure it, can you?
You can't measure it, no.
Yeah. And I think we made the point we took you through 3 or 4 slides in the last session 5, where it's just the only way to do this is you got to be mechanical. You can't flawlessly execute something that's changing all the time. Right, let's keep going.
However, what you don't know is exactly how the pattern your variables identify will unfold.
So you've got to make yourself available to something that you have no idea of what's going to happen going into the future.
Because every moment in the market is unique.
Correct. And this is a challenge. People, you're making yourself vulnerable, and you're surrendering yourself to the environment and completely opening yourself up for anything to happen to you. But what people do, as we know from James Clear's material, is that the moment that happens, the moment there's a stake, and they have looked at a set of variables that is coming from the market and indicates an opportunity to buy, then what they do is they automatically expect to be right. And this is one of the nexuses that we have to break for you to take on the necessary mental skills to become mentally fit to continue executing the market on a consistent basis, where you realize what your edge is offering, what the flow of the market is offering in the time frame and everything that you're trading in. So continue with making yourself available.
So with the perspective of making yourself available, that your edge places the odds of success in your favor.
But you only know that if you've got a mechanical system that has been tested to some degree, or you've done hundreds and hundreds of subjective trades and what your own personal edges, only then.
At the same time, you completely accept the fact that you don't know the outcome of any particular trade.
And this is this uncertainty principle.
Yeah.
You're certain, but you're uncertain. You are uncertain, at the micro level, and we discussed that in one of the previous sessions, but you're certain at the macro level.
So you're completely at peace with not knowing.
Well, just ask yourself this question as you're listening to this. How at peace can you be at not knowing, completely surrendering yourself and making yourself vulnerable to what's going to unfold?
So no discomfort or conflict, no FUD. What's FUD?
Fear, uncertainty, doubt. An IBM term from decades ago. That's what you had to do to the competition, make them FUD, right?
Make them FUD. And no expectation of being right.
So you have to be completely at peace with not knowing and feel no discomfort or conflict, no fear, uncertainty or doubt, and also have no expectation of being right. Now that most people will say, I think I can do that until there's something at stake. And to have things at stake on a continuous basis and to also have money at stake when you are sitting at 20% drawdown and have had 7 or 8 consecutive losses, those are the adverse conditions that we are talking about, getting your mental fitness to a level where you are still at peace in that environment at that particular point and continuing to play the game.
Adopting this perspective leaves your mind free of internal resistance.
No conflict.
That can prevent you from perceiving whatever opportunity the market is making available from its perspective, its truth.
And it's the truth. Whatever the market is doing or done up to that point, and is what it's doing now, it's the truth. And it's not what we are, and we spoke about the boy being bitten by the dog, is that we can self-generate what we perceive may or may not happen. And the moment we perceive something and it's self-generated in our head, that becomes our truth. And what we've got to do is make ourselves available to the truth of the market, communicated to us via price action, and to be able to act in that now moment according to our edge, which is the flow, without associating into the past or projecting into the future. That's the zone, effectively.
When we believe in something, we operate out of that belief as a natural function of who we are, without struggle or extra effort.
And the extra effort there is it becomes effortless. We don't need the discipline. We don't need to force ourselves to do something against our will. If there's any force against will, well, then you don't believe it yet. There's still something holding back that belief, and there's still energy in the old dysfunctional beliefs with respect to what you're trying to do. So we want to operate out of a belief that's a complete and natural function of who we are. It's become part of us. It's in our identity, to use James Clear's terminology.
So to whatever degree there is conflict with any other component of our mental environment, to the same degree there is lack of acceptance. I think a lot of members go through this through their development. They get to a point where they're starting to feel, accept some of the risks to a certain extent, and yet in the back of their mind there's still some doubt or whatever. And so they will throw up the idea of, these last couple of trades I've had, they've been losers. I think I need to do more analysis, that sort of thing.
Or I need to learn more about the market. I don't trust the market. I don't trust how the market's going to play out into the future. Well, is it going to go down forever? Are there not going to be any up legs or trends? Is the edge broken? People say the edge is broken or it's not good enough. And then they go to another edge and they keep trying to solve their belief issues, if you like, with respect to the market by analyzing more and trying to come up with a different strategy, a different edge, and they go from edge to edge to edge. And all of that is pure manifestation, not having the right set of beliefs that are consistent with being a long-term winner, consistent winner in the market, as by Mark Douglas's definition. Yeah. And you've got to catch yourself in the moment and go, why am I thinking like this? I'm wanting analysis to solve the problems of the way I think. And I've said many times, you can't analyze away the pain because if you move to a different edge, then you might find an edge that in a particular market period, that edge performs a bit better in that particular market period, but the next market period comes along and then that edge performs worse than the edge that you were performing in the first place. So it's this never-ending cycle you get yourself into of trying to solve the way that you think about the market by chopping and changing from edge to edge, and then you never get there. That's what we are trying to solve here. And that's what we're trying to solve. We're trying to solve how we think by changing the way we think, not by chopping and changing our tools. Poor workman always blames their tools and blaming something or somebody else for how you feel. We've got to reframe and redefine how we feel.
Right. It isn't difficult, therefore, to understand why so few people make it as traders. They simply don't do the work necessary. the mental work that is, to reconcile the many conflicts that exist between what they've already learned and believe.
So we've all lived a journey, we've all come a certain path in life and in trading, and we've got and by hook or by crook, the beliefs that we currently have been instilled in us from that journey. And what so much evidence shows, not from Mark Douglas, reading James Clear's work, but even reading many other books on trading, and there's a whole bunch of them over here on psychology as well as analysis, is that the way we think that gets us through everything else we do in life is not conducive to helping us to achieve our goals in the market. We have to change the way that we think. So we have to get all these conflicts that already exist and that we've already learned and believed, and we have to do the mental work necessary to reconcile these.
And how that learning contradicts and acts as a source of resistance to implementing the various principles of successful trading.
Which I've just said.
Not predefining your risk, not cutting your losses, or not systematically taking profits. 3 of the most common and usually the most costly trading errors you can make.
And just about every trading error can be put into those 3 categories. Yeah. And yet people make them over and over and over again, even though they consciously are aware that they shouldn't be doing it. So why do they do that?
Well, it's completely the opposite of everything there. They haven't predefined their risk and they haven't truly accepted the risk. As a result of that, there's chinks. There's the weakest chain in the link is that bit of the mindset that's holding the whole lot together.
Correct.
And so
absolutely. And they can give it lip service and they can say they do that, but they don't do it often enough that it can negate their edge and it can negate what they're trying to achieve in the market. And the thing here is that being aware of this and still doing it is highly frustrating. And you can get disgusted with yourself and disappointed with yourself and lose trust in yourself. And you've got to understand that fixing this doesn't happen at the analysis level or the process level. It happens at the mindset level. And it's not something that you can just cognitively decide to do from one day to the next. It has to be a belief that's built over repetitive series of experiences.
Yeah. These are the constant, never-ending, unknown, hidden variables that are always operating in every market. Always.
And they're hidden, but they're invisible as well, right? And we can't see them. Therefore, we don't think they're there, but they are there. And even though we know they're there at a cognitive mindset, to subconscious, we think we've got this. Yeah, I've got this, what's going to happen, right? And they're always there all the time. We just got to be totally understanding and believe that.
The best traders don't try to hide from these unknown variables by pretending they don't exist.
Which I've just said.
Nor do they try to intellectualize or rationalize them away through market analysis.
I mean, just think how silly that is for people who try and analyze away variables that they can't see.
Doesn't make sense.
I mean, effectively, that's what you're doing when you're trying to analyze away, losing, missing out, being wrong, and leaving money on the table. Is you're trying to analyze away a whole bunch of variables, which are market participants or future variables that are going to enact on these changing variables that are happening today or tomorrow. And there's a whole bunch sitting out there that we don't know how they're going to respond or react to the variables that are going to change tomorrow. And so when you try and do analysis to remove the emotional pain, what you're trying to effectively do is analyze away things and variables that haven't happened yet. I mean, that's impossible. So why do it? Somewhere along the line, we have to put trust in our edge and think from the market's perspective that the market goes up and down in all time frames. And when it goes down, that's going to generate some emotional pain to some degree. And the degree to which that emotional pain affects your execution of your process, of your flow, is the degree to which your mindset is not yet conducive to being a best trader. So that's what we have to do, is we can't analyze away, intellectualize away, or rationalize away through analysis. What is the dead certain that's going to happen is that the market is going to cause pain if you let it.
Quite the contrary. The best traders take these variables into account, factoring them into every component of their trading regimes.
But as we just said, defining the risk, systematically taking profits, and also cutting losses. And they do that without even thinking about it. It's just a habit. They just execute their edge with the known variables. Now, if you don't have known criteria and unambiguous criteria, then how do you define when to do that? How much money you allocate? If you don't have those rules, then, well, you just make them up as you go.
Yeah.
And we know then you don't have an edge. You don't know what your edge is as you go without those definitions in place.
For the typical trader, just the opposite is true. He trades from the perspective that what he can't see, hear, or feel must not exist.
It's like, that's the ostrich strategy, isn't it?
Put your head in the sand.
Yeah, that's right.
What other explanation could account for his behaviour? If he really believed in the existence of all the hidden variables that have the potential to act on prices in any given moment, then he would also have to believe that every trade has an uncertain outcome.
So the market is totally and utterly uncertain. So therefore, we've got to be uncertain. So if we have any degree of certainty or wanting to be right into the future, then we're not uncertain. We're not 100% and totally uncertain. And then we're thinking from our perspective, not from the market's perspective.
And if every trade truly has an uncertain outcome.
So if you've got a set of subjective criteria that you decide to get into a trade now, and for whatever reason, no matter where that source comes from, but that source is subjective criteria that chop and change, then how are you going to predefine your risk, cut your loss, and have a way of taking profits going into the future? You're going into this without any process. You're just going to leave yourself open. So the only way you would do that is if you think there's a degree of certainty. Why else would you do it? You'd only do that, act on those, if you think there's a high degree of certainty into the future that this trade is going to be good for you. Well, I can't understand how people operate like that. I don't now, but I know people. I know the great majority of people who trade in the market do it, and that is why we know from research coming out of Europe brokers and failure rates that they've got to report on every quarter is that 70 to 90% of active investors, active traders, and all different instruments lose money from quarter to quarter, and then take themselves out of the game within 12 months, 70 to 90%, because they're operating exactly like that. And we covered that in the first session, I think, when we spoke about the ladder, the competency ladder. So I know at your conscious level, when you're sitting here thinking this, first time you hear it, you're going to struggle with really understanding what this is and trying to apply it to yourself. But listen to it, read the material, and listen to this time and time again, because you are doing that to some degree. You have a projection to the future that there's some certainty about this action you're taking. That is why you're not defining a risk. And that is why you are not, from a money perspective, and that is why you're not defining clear, no wiggle room, unobjective criteria for when to get out or when to take a profit.
The answer is quite simple. The typical trader doesn't predefine his risk, cut his losses, or systematically take profits because the typical trader doesn't believe it's necessary.
And that's what you do when you're trading subjectively, and you're not trading. If you're trading with discretion, that's exactly what's happening. So how do we get these skills? As we've said that many times, you've got to do it with a mechanical system.
So paradox, random outcome, consistent results.
Which is what we've spoken about. And this is the uncertainty principle, really, that at the micro level, the random outcome, at the macro level, consistent results.
So casinos make consistent profits day after day, year after year, facilitating an event that has a purely random outcome.
And we spoke about this in previous sessions,
Events that have a probable outcomes can produce consistent results.
And we've got to believe in that with every part of who we are.
If you can get the odds in your favour and there is a large enough sample size.
Correct. So that's the prerequisite. So you've got to have an edge. You've got to have an edge.
Yep. If a large enough number of hands is played, patterns will emerge that produce consistent, predictable, and statistically reliable outcome.
The casino is one of the examples that Mark uses in that, but the example that we use are our mechanical systems and live traded real money portfolios. So now we're going to move into the skills acquisition plan, which we've implored on you today that if you haven't started already, you should start before the next session right away. Let's get into the process, define your starting capital, start up the new portfolio in the portfolio manager and beyond charts, and get going on this. So you have a process with a statistically reliable edge. So you've really got that. The edge produces the flow. You execute the edge flawlessly to produce a consistent, predictable, and statistically reliable outcome, as per Mark Douglas's definition. We discussed execute flawlessly in the previous session, in session 5, and you should go and watch that again, because that really does make the connection between doing this mechanically or not doing it mechanically. In fact, there's no other way, and which is why when you follow the logic that we cover there as to why Mark Douglas said you can only do this mechanically in a systemized way. And that was his definition. I defined consistent results as a steadily rising equity curve with only minor drawdowns that are the natural consequent of edges that didn't work. So the edge that didn't work, that's a lost trade. So you're going to have those, and you're going to be in this flow, and you want to get a steadily rising equity curve. So some other things to do with the skills acquisition plan, and we're starting to get into, we speak about journaling, is that when you are doing this, and this is page 200 out of Mark's book, is write down the 5 fundamental truths and the 7 principles of consistency, and keep them in front of you at all times when you are trading. Repeat them to yourself frequently with conviction, with emotion. Get into it, say it aloud, put yourself in a soundproof room if you have to, if you feel silly about somebody else hearing you, or go down to the beach and go 100 meters out and say it, or whatever, right? But you got to say this with conviction. But when you start doing it, you'll feel silly, but the more you do it, the less silly you will feel. Make that a habit as well. So I just wanted to finish up here talking about forming habits and beliefs. This is now also setting us up for the next sessions, and we're going to draw on James Clear's work here as well. And we'll get through this quite quickly because we're going to get into this in more detail in coming sessions. Habit formation is the process by which a behavior becomes progressively more automatic through repetition. The more you repeat an activity, the more the structure of your brain changes to become efficient at that activity. Neuroscientists call this long-term potentiation. So a lot of this, in fact, just about all of James Clear's work, which is backed by science, and he keeps on referring to scientists having done all these experiments, is 100% aligned to what Mark came up with in the 1980s and 90s. I think, in fact, it goes back to the 1970s, 70s, 80s, and 90s with all his work as a coach. So this is all backed up by third party. The amount of time you have been performing a habit is not as important as the number of times you have performed it. And I think, in the skills acquisition process, you can do it with ETFs or you can do it with stocks. And I think, to go through the skills acquisition process, it would be better to do it with stocks just because you can increase the number of times. There'll be more trades, you'll have more open positions in your portfolio, and you'll do more trades. So this is a performance, it's a function of the number of times you've done it. And then you can, when you get into your investment plan for the longer term, then we can consider ETFs as an ongoing once you've got the mental skills. Right.
So repeating a habit leads to clear physical changes in the brain. Like the muscles of the body responding to regular weight training, particular regions of the brain adapt as they are used and atrophy as they are abandoned.
So there we're talking about energizing particular regions of the brain. So that's energizing new beliefs and new habits, and then atrophy of the ones that need to be de-energized. So you're putting more power, more energy into the ones that you need. And while you're doing that, you are de-energizing and the ones that need to be abandoned. Now, from the work and research I've done is that we can't completely abandon a belief. It just gets de-energized and it sits there unless we continue to work on these beliefs and these mental skills and attain this, when we get to that mentally fit stage, we have to keep mentally fit. And if we don't, and you start energizing the dysfunctional habits, the dysfunctional beliefs, they could prop up again. And how do you do that? You can enforce dysfunctional beliefs by every time that you break a rule. But if you don't have a rule, if you're trading subjectively, well, then you just keep on energizing those dysfunctional beliefs. So one of the first things you have to do, as we keep on saying, and that is why mechanical is the only way to go to attain these skills, is that you have to have some rules by which you can de-energize those dysfunctional beliefs. Otherwise, they're just going to start, you're going to keep on reinforcing them and they're going to never go away.
All habits follow a similar trajectory from effortful practice to automatic behavior, a process known as
automaticity. Yeah, so a big word there. So this is a known thing, right? And scientists have given these names, right? So we want to go for it's effortful practice, series of experiences. And the more we do those, we create automatic behaviors. So we don't even think about doing the wrong thing. So we've got to keep doing this. And this is automaticity.
Automaticity is the ability to perform a behavior without thinking about each step, which occurs when the non-conscious mind takes over.
And now that was the levels, the ladders of competency, unconscious competency. So this all ties together from various sources. And all we are doing here is we are providing an environment really to convince you, to motivate you, to take on the skills acquisition plan, to step into a process that builds beliefs that are going to last you forever, right? And the degree to which you don't do this is the degree to which you're going to continue getting the same results. And I'm sure you don't want to do that. I'm sure you want to improve and get better at this. Right, homework. Some revision first.
Read part of Chapter 7 of Trading in the Zone, Thinking in Probabilities. So a revision of that, which was covered in Session 3. Yeah. So there your page references 101 to 113, Trading in the Zone.
And that'll cover some of the stuff we've done today. Yep. And then homework for next session
is reading Chapter 8 of Trading in the Zone. So working with your beliefs. So they're the page references there. And read doing the exercise. So Chapter 11, those 2 pages, 199 to 201, Trading in the Zone.
The last 2 pages, and this time you only have to read it once. So this should be your 6th reading of doing the exercise at the end of the book.